I read a quote the other day that stated the riskiest thing we can do is play it safe. When it comes to our investments, it seems we are constantly pursuing safety along with the highest return we can find. Since the Federal Reserve started raising interest rates in early 2022, investors have been able to enjoy some of the highest short-term saving rates in years. It's been 22 years since the Federal Reserve rate has been at 5.5%. Safety with higher rates, how could you go wrong? The term cash trap is a risk that investors in the current market environment need to be aware of. Cash trap is the risk of investing in high short-term rates that can ultimately prove temporary. Rates will eventually decline and investors miss the price appreciation associated with a diversified fixed income portfolio, and are also forced to reinvest at lower rates. Investors should be focused on building a well-balanced portfolio that meet their long-term goals, possibly foregoing some of the short-term benefits that come from higher rates. The third quarter of 2023 was the first reporting period in 3 quarters where broad equity asset classes were down. The S&P 500 dropped 3%, while international stocks were down slightly more than U.S. stocks. Bonds were down about 3% for the quarter as long-term rates rose, creating a flatter yield curve. Even though third quarter was down, markets in general are still positive for the year, with the S&P 500 up 13% year to date. The interesting anomaly in U.S. markets this year has been the incredible upward movement of the top 7 growth-heavy tech stocks of the S&P 500, known as the Magnificent Seven. These 7 stocks have driven 85% of the return of the S&P 500 this year because of their outsized weighting in the index. Without them, the index would have returned less than 2% through the same period. The Federal Reserve seems to be at or near the end of their rate hiking cycle. While the Fed projects one more rate hike, markets point to the Fed being done raising rates. The economic effects of higher rates, slow global growth, and geopolitical unrest make for continued volatility in markets in the near term. Risk of a recession looks to be pushed into 2024, along with a greater chance of a shallow outcome due to a stronger consumer spending and healthy labor market. In any event, with all the uncertainty surrounding us in our emphasis on strategic asset class diversification, manager value, and staying with a long-term investment plan in our portfolios is how we steward resources to honor God at MB Foundation. Please give me a call or respond to this email if you have any questions on how we manage funds at MB Foundation. Thank you.